Greetings from Kotak Mutual Fund. I hope you and your family is safe and healthy in these challenging times. What a run we saw in last month. It was the fastest ever 1000 point rise in Nifty against all expectations. For any market to move, it requires Triveni Sangam of sentiments, money flow, and fundamentals. If you are in good mood, you will see glass half full. If you are in bad mood, you will see glass half empty. In the March, April, May 2020, as well as 2021, sentiments were badly impacted because of COVID-19. Now, as number of active cases have stabilized, vaccination has picked up record pace, barring few parts of India, other parts are opening up and normalizing, sentiments are improving, they are turning positive. It will be fair to summarize that as long as third wave does not restrict economic activities and does not become as ferocious as second wave in terms of active cases and death, we should have sentiments generally positive, which will support the market. From a money flow point of view today, domestic investors led by retail and high net worth individual, mutual funds, insurance companies, and pension fund all are buyers in market. Last 18 months, retail and HNI has made a lot of money in market and hence are likely to continue investment in the days to come. The same retail investors are also putting money into mutual funds. We have seen record mobilization in mutual fund NFOs. SIP is crossing now 9,000 crore a month. Between mutual fund, insurance, and pension fund, we could easily see upwards of 300,000 crore worth of buying in equity market. Foreign portfolio investors are also generally buyers in the market. There have been occasional sellers also, but by and large, they are net buyers. Since India opened up for FPI investment, overall about 10 lakh crore has come into Indian equity markets. Of that, almost 26% plus came in FY 2021. Obviously, on that kind of large inflow, next year is likely to see subdued inflow. So far, FY 22 year to date, FPIs are marginal buyers, and every day that number swings between marginal buying to marginal selling. From a money flow point of view, our markets are well bidded. Retail and HNI investors have made a lot of money in last 18 months. They are likely to be net buyers in the days to come. Mutual funds are seeing record collection in their NFOs. SIP inflows have crossed 9,000 crore per month. Between mutual funds, insurance companies, and pension funds, overall investment this year could exceed 3 lakh crore. Foreign portfolio investors have been marginal buyers or marginal sellers in FY 22. But we must remember that in FY 21, they brought lots of money. Almost 26% of total FPI flows, which we saw since beginning in Indian equity market, has come only in FY 21. On that kind of large flow, some moderation is expected in FY 22. However, for the rest of FY 22, we believe FPIs will be bigger buyers than what they have bought till now. This is primarily driven by, one, how China is cracking down on their technology companies. Global investors are suffering losses over there. and it is likely that their allocation will shift towards India. Number two, the recovery in economy in India is now likely to be better than some of the emerging markets which are getting impacted by COVID-19. Put together, our markets are likely to be well bidded from money flow point of view. But money flow and sentiments are fickle. They can change overnight. At the end of the day, markets will be driven by fundamentals. Stocks are slaves of earning power. We have seen remarkable recovery in corporate profitability in FY 2021. Tax cuts, reduction in debt burden, reducing interest cost, tighter working capital management, increasing productivity, and cost control all contributed in improvement in corporate profitability. Lockdown impacted June 20 quarter show NSE 500 companies profitability coming at about 32,000 crore. The same numbers for March 21 quarter came at roughly 2,11,000 crore. Money flow and sentiments are fickle. They can change overnight. What we need is fundamentals. They support the market permanently. Stocks are slave of corporate earning. We have seen, thanks to tax cuts, reduction in debt burden, lower interest rates, tighter working capital management, productivity increase, and cost control contributing to increase in profitability. Sentiments and money flow are fickle. They can change overnight. Stocks are slave of corporate earning. We have seen remarkable improvement in corporate profitability in FY 21. That has supported market rise. Lockdown impacted June 20 quarter profitability. NSE 500 companies profit came at 32,000 crore. But thanks to the tax cuts, reduction in debt burden, corresponding reduction in interest cost, increased productivity, cost control, and tighter working capital all contributed to all-time high corporate profitability in March 21 quarter at 2,11,000 crore. It's almost a 7 times increase between June 20 quarter to March 21 quarter. This has resulted into sharp upswing in Nifty earning per share. For FY 20, Nifty earning per share came at about 475 rupee. I'm talking rounded off numbers. In FY 21, it came at about 550 rupees, a growth of about 15%. FY 22, where lockdown impact will be minimal, Nifty EPS is expected at 750 rupees. That's a growth of 38%. FY 23, growth will moderate at about 870 rupees, which is a growth of 16%. Today, at 17,000 odd Nifty, it is trading at 32 times FY 21. It's trading at about 23 times FY 22, which is 6 months forward. And it is trading at about 20 times FY 23, which is 1.5 year forward. These valuations look reasonable. They don't look expensive. And obviously, they don't look cheap like March 2020. Now, one can argue whether corporate profitability will keep on improving. Tax cuts are not going to happen anymore. Interest rates are actually expected to rise. Working capital and cost control probably have given short-term benefits, and they are unlikely to be as much over medium term as they were in last few quarters. productivity increase will have limited contribution in the quarters to come. And yet market believes that corporate profitability will rise. We believe the reason why market is believing this is because of operating leverage. Today, most industry in India is operating at 65, 70, 75% capacity. As demand picks up, as economy opens up, there will be increased capacity utilization, which will create operating leverage. Your fixed cost will be distributed over bigger volume, in turn increasing margin, and in turn sustaining corporate profitability. This Triveni Sangam of positive sentiment, thanks to vaccination and stable COVID cases, gradual opening up of economy, money flow coming from domestic and global investors, and most importantly, steady improvement in corporate profitability, all are supporting market. We believe at this point of time, valuations are neither cheap nor expensive. They are fairly priced. We might be trading little above our historical averages, but compared to global averages, we are fairly priced. To investors, our recommendation is you have to be equal weight between large, mid, and small, as the return differential between large cap, mid cap, and small cap funds will be significantly narrower in the quarters to come compared to what we witnessed in the past. Every correction will be a great opportunity to invest and increase equity allocation. If you are looking to invest lump sum, Kotak Balance Advantage Fund or Kotak Asset Allocator Fund will be appropriate. If you are looking to invest via STP or SIP, then for conservative investor, Kotak Blue Chip kind of large cap fund or Kotak Equity Opportunity kind of large and mid cap fund will be appropriate. For an average investor, a flexi cap fund like Kotak Standard Flexi Cap or a large and mid cap fund like Kotak Equity Opportunity will be appropriate. For an aggressive investor, mid cap fund like Kotak Emerging Equity, small cap fund like Kotak Small Cap, or concentrated fund like Kotak Focused Fund will be appropriate. I also want to stress importance of SIP. SIP is Harfan Maula product. It's all weather product. Today, it represents confidence and trust of crores of investors, giving more than 9,000 crore per month. It represents a more disciplined way of investing and participating in India growth story. If you look at Kotak Equity Mutual Funds bouquet, almost all our equity funds are giving double-digit return across various time periods. Across most time periods, we are also generating alpha over benchmark index and adding value to our customers. Today's return are almost dream come true for our investors. However, this dream come true returns are captured only by those investors who went through the meltdown of market in March 20. In March 20, our equity funds were delivering negative return for more than 3 years SIP. It tasted the nerves of investors, but people who continued their SIP, who maintained their trust, today are getting double-digit returns. It is extremely important to show March 20 as well as August 21 performance to investors so that they invest in SIP with right attitude, right mindset. There is also a misconception that SIP is meant for 3,000, 4,000 rupee investment. In all equity funds, whether you invest 3,000 rupee 30,000 rupee, 3 lakh rupee, or 3 crore rupee. Returns are the same. We don't differentiate between size of investment. Many people have started SIPs, but they haven't topped it up as their income have increased. It is extremely important to top up SIP to achieve your financial objective. While there is Triveni Sangam in market about sentiment, money flow, and fundamentals, does it mean that there will be no correction in market? Undoubtedly, no. The recent pace is showing some amount of waiting cash getting invested into the market. There are pockets where we could see some amount of exuberance. Some small and mid cap stocks with low floating stock and concentrated buying are seeing vertical rise. These are all areas which one should avoid. We believe market will see ups and downs. We believe markets will see correction unless one of the fundamental factor changes related to sentiment, money flow, or fundamentals. Market is unlikely to witness big crash. A regular investment through SIP or STP, a disciplined investment through asset allocation, equal weight to equity, equal weight to small, mid, and large cap funds, and a long-term investment horizon and buying on the dip will be prerequisite for making money in this market. We wish you happy investing. Stay safe. Take care. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.